Right, hi guys, I'm Gerald. I'm the head of research for CoinMarketCap, and today I'll be telling you guys about market-neutral derivatives, crypto derivatives trading. So it's more like how a trader views the markets and how I would look to arbitrage certain exchanges, certain spots, certain products, and yep. So before I get on to the whole presentation, the first slide is the most important, right? This is not investment advice. Please do your own research before executing any of the strategies mentioned, right? So now to get on with today's agenda. So my background story. So I first started trading as a proprietary trader, interest rates and commodity futures. I mainly specialize in spread trading, so market neutral strategies, mean reversion strategies. And I was first approached by my friend sometime in 2018. He asked me to look at the crypto markets, right? So what is there in the crypto markets? Could you apply any of these strategies that I'm specialized in to look at the markets? So when I first looked at the markets, I was looking at mainly spot markets. And I was like, hey, it's not really exciting. What's there, right? So he said, when I look at the perpetual swaps, the futures, and when I looked there, I was mind blown, right? So I wasted no time. I did the research, and we co-founded Hashtag.Capital sometime around in late 2018. We never looked back, we traded these crypto derivatives, and was acquired by CMC to help them improve pricing algorithms in just a few months ago. Right, so the agenda for today. The first part I'd like you guys to understand is what are derivatives and what makes crypto or Bitcoin futures so special vis-a-vis the traditional side of things. Secondly, I'd like to talk about the curve, right? So what is the curve? It's basically how all the different products in the space, spot, perpetuals, quarterly futures, weekly futures, how they are all different unique products in the space, and how I visualize as a trader all the different types of spreads that you can execute on and find alpha within all these different products. Lastly, I'll talk a little bit about executing the trade. What are the risks involved? What sort of execution methodology? And then, sounding all about by saying what to look out for if you want to do this type of tradings. And if not, at least understand what the mindset is of a trader when looking at all these different markets. So the first question, I think you guys kind of already know. This audience is quite savvy. I'll run this through. What are derivatives? Basically, any instrument that is not the spot. So, for example, you have perpetual swaps, futures, options, warrants, and the purpose of derivatives is meant for hedging, meant for speculation, as well as to price things like volatility, interest rates, and so on. So what makes it so special? And this is what I saw, and this is what made me mind blown. So on the side of the screen, you can see this is what a Euro spot against the Euro futures spread looks like. So it's the price differential between the spot market and the futures market for the traditional side of things. As you can see here, if you are a savvy trader, what you would do is buy the spread, right? You just buy the spread here, take it to delivery, make money. It's not so simple. Why? Because if you were to execute this trade here, you would have to pay something called the funding rate, the basis rate, and that is the interest rate differential between the Euro and the USD. So essentially, if you were to do the trade, where I say long here, you could make money on the spread, but you won't essentially not make money because you have to pay the funding rate. So it becomes very, very difficult for any trader in the traditional side of things to execute this arbitrage and make profits, unless you're really fast, right? So that's where the whole HFT thing is going about. So now, what is the crypto spot to futures look like? Yep, this is what it looks like. It's ridiculously wild, crazy. So what makes this whole thing so crazy? This is basically the perpetual swap on BitMEX versus OKX's 3-month futures. So what makes this what causes this craziness in this market? Well, I like to call this the decentralized interest rate theory, because it's the first time that a product like Bitcoin has no central bank, right? So there's no control of the central bank, whereas in the Euro, you have the ECB. For USD, you have the Fed central banks. So because there is no one pricing in interest rates from a central bank basis, it creates a lot of volatility. Everything is priced based on supply demand for the markets, traders alike, right? So it creates this whole volatile markets where you look something like this. This is the differential which I saw, and that was what made me mind blown, because I'm a curve trader, I'm an interest rate trader, and I looked at this and was like, holy,
is that a typo, or
you get it. So to add on to that, we have something called leverage in Bitcoin BitMEX 100x, OKX's 50 to 100x, and you add that all together, you have this whole crazy volatile markets that is difficult to price, and that's what traders love, because that's what essentially caught my eye and made me so excited about trading crypto derivatives. So now to get on to it, what is the product? What are the products in the space, right? So we have the spot markets, we have perpetuals, we have weeklies, monthlies, and so on. So spot markets is quite relevant here because what's happening is a lot of these products are cash settled. So we have places like Coinbase, Bitstamp, Kraken. These are the usual suspects when used to price the Bitcoin index that is for cash settlement. So on the perpetual side, we have the big name, BitMEX, Deribit, OKX, and Bitflyer in Japan, and Kraken as well. And for the others, you have the weeklies, as you guys know, OKX, Whoopee, 1 month, CoinFlex, CME, and so on. So this is what I call the Bitcoin curve. So what makes all these products different, special? It's something called the contract specifications. It's before trading any product, every trader should read these contract specs, understand what they're trading, because this is what defines the product. So the first one will be delivery mechanism. We have cash settled, which is kind of the most popular way to settle a Bitcoin futures product right now. Of course, now we're going to move into more physical delivery for BAC, for CoinFlex, and so on. Right? So it's two different delivery mechanisms, and you need to know the difference between the two. Next, index components. If it's cash settled, what makes the index that settles a product? So you need to understand which exchanges, which market pairs. Is it based on USD or USDT? Very, very different. The denomination, is it an inverse future? Is it a vanilla future? Or is it settled in Bitcoin or USD? That's something that everyone needs to know. And the other things like the timing for delivery, for example, BitMEX and OKX has different delivery settlement timings. And that is very important because if you get that mixed up, you could end up your position getting mismanaged, right? And the different rules for trading, what the comms are, what the funding rate timings are. And all this, essentially, knowing the contract specs, defines the derivative that we are trading. So let me give you a little rundown of what defines the perpetuals, because these are the two products that are most heavily traded in the space, right? The perpetuals and the futures. So what we have here is BitMEX designing this product, and it's basically what they tried to do is design a derivative that had no delivery timing, had no delivery perpetually, and they wanted to create a product that was very closely priced to spot. So how did they do it? You have the Bitcoin index, which is priced by the spot markets, and then you have the BitMEX perpetuals. So, for example, if the BitMEX perpetuals trades as a premium, what happens then is you have this mechanism called the funding mechanism, where longs pay funding to shorts. This creates the incentive for people to go short the index, the swap, and causes both this to converge over time. So essentially what they created is a product that tries to mimic spot and creates incentive for traders to go short when the perpetual swap is higher than the spot and converges over time, right? So this is what they designed. Conversely is so, if it's at a discount, short pays funding to longs, and convergence happens. So because of the incentive based on funding. So this is the rules for perpetuals, and understanding these rules is important because BitMEX is perhaps the most liquid markets we have. Next is the futures, and for futures, it's only one rule. At convergence, price converge. At delivery, price converge. So the Bitcoin futures, essentially any futures for the fact, could fluctuate wildly before delivery, but there's only one rule. At delivery, futures price will converge with spot price. And that is very specific. So that means that if the futures delivery is somewhere like 2 quarters out or 3 months out, you could expect a lot of volatility because there is no guarantee of convergence only at one point in time, right? So because that, it always fluctuates. And that is what creates the excitement in this whole Bitcoin curve. So now I've talked about the way the products are designed. Now we look at the two ways you can design spreads around this. I'll call this vertical spreading, horizontal spreading. So basically, vertical spreading means same product, different exchange. So I could give a few examples. BitMEX's perpetuals versus Deribit perpetuals. In fact, even spot exchanges, Bitcoin on Coinbase, Bitcoin on Bitstamp, I think they all fall under the same category, a vertical spread. Because what they're trying to do is arbitrage the difference between the two, whereas for horizontal spreading, it's a little more unique. Because as you can see, there is a lot of different durations, spot, perpetuals, weeklies, 2 weeks, quarterlies, 1 month, and you're trying to create a spread between the two, perpetuals versus the monthlies, perpetuals versus the quarterlies, weeklies versus the monthlies, weeklies versus the quarterlies. There is so many permutation combinations, and that's why I would say it's a lot harder to trade because you need to understand the different dynamics between all these different products to construct something that makes sense. So given all these different permutation combinations, the next question to ask is, what makes a really good spread to trade? And this is what I came up with, my framework for deciding what makes a good spread. I call this the Holy Trinity because it is extremely difficult for any trader to design a spread that fulfills these 3 criteria, namely cost of execution, risk of volatility, and ease of execution. So let me give you a few examples what I mean. So on this side of the screen, you have a vertical spread. it could be anything, right? So, for example, I use Deribit versus BitMEX's perpetuals. You can see that both these products are very, very correlated. They are in a very, very tight trading range. However, if you want to buy the bottom, sell the high, buy the bottom, sell the high, you could. But it is extremely difficult to execute because why? Everyone is doing the same thing. It is something that, if you're a trader, you just want to buy, sell the difference. This happens in the spot markets where competition rolls, and even though the strategy is not risky at all, because if you just execute a spread, you wouldn't go wrong. You just not be making money. But that's the problem because why trade when you're not making money, right? So essentially, there is a push-pull between these two factors. If a strategy is risky, it's easy to execute. If a strategy is very risky, if strategy is risky, it's very easy to execute, and vice versa. So let me talk about the ease of execution. This is the perpetuals versus the quarterlies. And you can see it's really, really well. Why? Because there's no one really competing for the same price with you. Everyone has a different perspective of price. Everyone has a different view on where the spreads could go or where the direction of the markets could go. No one's really competing because they know that there is implied risk in executing a spread at any point in time. So there is no real competition for these spreads. And to add on that, the cost execution, the commissions, right? If you execute a spread that has little upside or downside, the cost of the ratio between the cost you're paying is going to be very, very high versus the profits that you make. The same can't be said here. If it's something that is very easy to execute, if the spread is volatile, the comms will make a very, very small portion of the entire trade. So because of all these factors in play, this is what I call the Holy Trinity. Very, very difficult to find a spread that has convergence of easy, cheap to execute, very low risk, and very easy to execute. If you can find one, that's why I put the Holy Grail there. If you find one spread that has all these 3 points, it is the Holy Grail of trading, for spread trading at least. And that is what creates the competition in markets. So the next slide, this slide is something that I think is most important for any trader because if I were to talk to any trader, I think there's only one thing that a trader should know. It is to understand the risks that they take on the markets when they put on the trade. I think this is something that every one of you guys should know as well. So understanding the risk is very, very important. And these strategies are not risk-free, right? So where are the risks involved in these strategies? Three points: liquidation risk, inventory risk, and delta hedging risk. Let me run you through a few points more in depth. So what is liquidation risk? Now, given that we're going to execute spreads, there's a good chance that you'll be trading on BitMEX or OKX, Deribit, all different exchanges. While your whole portfolio may be hedged, essentially you're long BitMEX, short OKX, it could be hedged because you're long short the market, but you have an outright risk on BitMEX and you have outright short risk on OKX. If markets really go blowout, there is a good chance that your price could be liquidated if you are very heavily leveraged. So this is what I mean by liquidation risk. I think that happened sometime in November 14, where I first looked at the markets and I'm like, wow, there's a 10% basis spread between the weeklies and perpetuals. Why? Because everyone was just puking out. Everyone got liquidated on OKX. So that's something that you need to be mindful of. Do not get liquidated when you're trading. Next, I'll talk about inventory risk. Inventory risk is about holding the inventory because if you realize this is not a spot arbitrage, right? You can't just withdraw the Bitcoin, the position out. You need to hold the position to delivery or to profit. So because of this, executing a spread for executing a position requires you to hold the inventory. And if you're holding inventory and spreads blow out against you, you'll be drawn down. And if you're too leveraged, you're going to see a 10% drawn on portfolio. And that is never ever good for a market neutral strategy, right? So inventory risk is important. Understanding the risks of the spread you're executing, the variance of the spreads, and then managing your risk in that way. Lastly, delta hedging risk, something basic. If you're filled on the bid, you need to put a sell outside. And if you don't manage your play, if you get filled on one market and no hedge order on the other side, you essentially transform from a market neutral strategy to a market directional basis. And that is not good if you're managing very strictly. So it gets very complicated when you have 5 different exchanges with 6 different products, right? So it's across the whole stretch. And then how do you then manage your risk across the whole strip of products? And that is what is required if you want to do these strategies. So now, after understanding all these different risks, we talk about the two ways you can trade spreads: mean reversion, directional spreading. So for mean reversion, it's basically holding the futures to delivery. So I'll show an example later, but it's about converging the spread. So if the perpetuals is here, the weeklies are here, you want to trade to convergence, sell weeklies, buy perpetuals, hold it for a week, converge. There is a good chance that if you are doing so, you have to pay the funding rate as per the contract construct. The next point is about direction spreading. Instead of converging the spreads, you're betting divergence. So that is a much more riskier strategy. But if you do that, and you're right about it, you would essentially you'll be winning twofold. Why? Because you're receiving funding on the short leg of the perpetuals, and you bet that the futures go further out. It creates a win-win situation, which is quite good, I mean, yeah. But the problem in that is it's very risky, because we know for a fact the duration futures would converge at settlement. The same can't be said. We cannot bet. It's a bet that it's going to diverge, right? So this is what I call directional spreading. So this is an example of what I'm talking about. So this is the price of the spread. This is the time. This is the price. So we are right now in the present. What do we do now at the present? Do we want to mean revert the spread, buy perpetuals, sell the futures? Or do we want to trade directionally? Sell the perpetuals, buy the futures, and bet that it's going to diverge further, directional. I mean, this is down to experience. If you're an experienced trader, you can look at the funding rate, look at the market sentiment, and you can decide then. But this is what makes a good trader, deciding whether to do it mean reversion way or to do it directional, and how you manage the whole portfolio like that. So to add to that, if you were to take the directional route, you also can reverse your trade after some time playing the mean reversion route. So there's something, it's a lot of permutations, there's a lot of combinations in how spread trading is designed. It's not just basically, it's not so boring as to mean revert, mean revert, mean revert. Many ways to do it. It's down to the experience and the skill of a trader. So I'd like to touch a little bit about spot borrowing lending market, because I think it's like what Sue has said earlier. It's basically this whole synergistic way of looking at interest rates and markets. So this is what I'll touch on it briefly. We have the spot market here, and we have the Bitcoin 1 week futures, for example. So if there's a difference, right? The weeklies trade at a premium over the spot. What do you do as a trader? You first borrow USD from the loan markets or from exchanges. Look at the interest rates, of course, checking that you are making a profit by arbitraging this difference. Buy Bitcoin spot and sell the futures. So hold it to delivery, converge to delivery, cover your position of futures, sell back the Bitcoin spot, repay the USD and any interest that you're occurring, and pocket the difference between the interest rates that you have to pay for borrowing USD and the difference in the spreads. So that is where arbitrage profits come in. The converse is true. If it's at a discount, you borrow Bitcoin, checking interest rates, of course, selling Bitcoin and buy futures. Wait for delivery, convergence, cover futures, buy Bitcoin, repay. Yeah, you get a whole, it's the same thing, right? So what happens here is, because of this mechanism and how traders react to markets, everything is linked. It's a whole ecosystem of interest rates, and that is what I'm trying to get you guys to realize, that interest rates don't exist in a silo. It's very, it exists as an ecosystem. So this is what I view the whole ecosystem is at. Derivatives, spot, borrow lending markets, all the same thing. So to put everything all in practice, there are 4 different things that I'd like you to realize if you want to trade these strategies. Firstly, is always be mindful of where your liquidation price is, right? This is something that I cannot stress for enough. I've seen big hedge funds getting liquidated, and it's not fun, right? They're going to lose millions of dollars because they were over-leveraged and they didn't balance their accounts fast enough, and the markets were just too volatile. Bitcoin is a volatile product, so always be mindful of where your liquidation price is. Secondly, execution costs. If you're a HFT, if you're going in and out of markets really fast, the costs will add up. And of course, we have to pay co-location costs, engineering costs for spreading infrastructure. And nextly, execution efficiency, right? So this is where it gets a little HFT, gets a little technical. The truth is, there are different exchanges that offer rebates for making as well as taking cheaply. So it's how do you design these spreads? The perpetuals, do you always make on the perpetuals? Do you always sell the futures? Because you receive rebates from BitMEX by bidding the perpetuals and selling the futures. So this is where I say it's down to the trader to understand these different markets, to understand the efficiencies that they can exploit by making on one side, taking one side, or in fact, if they're really advanced, make here, right? It's risky because if you make here, get filled market runs, you have to sell hard, right? Because if not, you're unhedged, the delta hedging risk. So this also creates the dynamic for competition. Everyone's doing the same thing. Everyone's buying here, selling here, right? How do you make sure that when you get filled, your competitors do not take your fill when you got filled here, right? So this is where competition exists, and this is where people play the game, the HFT game. Lastly, understand inventory risk. This, even though it's market neutral trading, there are risks involved. Like for example, the one I stated, November 14, spreads blew up by 10%. That's ridiculous for market neutral strategy, especially when you're leveraged 3 to 4x. Imagine being down your portfolio by 30, 40%. It's just way crazy. And this is where Bitcoin is very unpredictable in terms of volatility. Right now, we're in a very stable market, same as what happened in November 14. Is there going to be a huge run on volatility? I do not know, but there's a good chance it will, because as we know, crypto. So always be mindful of where your inventory risk is in this whole markets, and understand that this, even though it's market neutral, it is not risk-free. So yeah, this is my conclusion. 4 points. Firstly, I hope you guys realize that trading doesn't need to be directional trading. It can be spread trading, it can be market neutral, and given what we see in the crypto markets, it's pretty fun. Secondly, market neutral doesn't mean risk-free. Like I talked about that, holding spreads doesn't mean, even though you're hedged, it doesn't mean that you're risk-free and then you can go about your daily life. You need to manage your risk even though it's market neutral. Thirdly, Bitcoin markets will always continue to mature. What I mean by this is, I think there's a good chance that people will start to develop new products, new strategies, new exchanges, and hopefully this market really matures and be as professional as the traditional world is. And lastly, I think market neutral strategies will always be interesting in crypto world. Why? Because of decentralized interest rates. And I think this is something to stay. Hopefully you guys understood what I'm said so far, and thank you for listening. So to end off the whole presentation, we have a CoinMarketCap conference sometime in November. So yeah, feel free to attend. It's free. Okay, thank you for listening.
All right. Thank you. We do have some time on the clock for questions. If you want to get some digs in with Gerald, you've got a head of research for one of the world's biggest information providers in this sector. So now is the chance to get your digs in and access his big brain. Is there a hand that wants to go up in this room? I got a hand down in front here. There we go. Where's my man with the microphone? Here he comes, on his way. That was a hand. It wasn't just a stretch, huh? Okay, yes, definitely. Here he goes. Thank you.
Do you trade now? Why did you sell the CoinMarketCap? Wouldn't you make a lot more money just by trading?
Yeah, okay. So that's a very good question. I think, okay, so one of our LPs was the owner of CoinMarketCap. So he saw what we were doing. So basically, we were still transitioning from the futures market to spot market, and he offered us a good deal that we couldn't refuse, if you get my drift. Yeah.
Okay.
Yeah, I mean, the markets are one thing, but I think in CoinMarketCap, our team wanted insight change in markets, and given what we could do with CoinMarketCap as a brand, we felt like it was a much better opportunity for us to insight change in markets. Does that make sense? Yeah. All right.
We got some more questions from the floor. Last chance. Yeah, okay. Gerald, I think you've done your duty. Thank you very much.
Right.
Ladies and gentlemen, let's hear it for Gerald Chee from CoinMarketCap.